All right, here it is. The Federal Reserve has decided not to cut interest rates. And what does that mean for homeowners, potential home buyers? What does it mean for the markets out there? Whole bunch of information to go over here, but I'm going to get it to you in a real short time period. So first things first, the Federal Reserve Chairman Jerome Powell came out and said that there's been a lot of recent progress in lowering inflation. And what does that mean? That means that they're going to be able to cut rates soon, they feel. But they've decided to leave rates right where they are. So let's look into a few things. Here's a chart going all the way back to 1955 of where interest rates have been. They go up, they go down, they go up, they go down. Now, they go up when inflation gets high, they go down when inflation comes down, and unemployment goes up. The Federal Reserve has two jobs: to keep unemployment as high as possible, as low as possible rather, keep employment as high as possible, and also keep prices stable. So you can see here, this is where the interest rates have been. The benchmark rate is what they call it. And in a little more modern history, in the last 2 decades, in the 2000s, inflation was taken off. They rose rates. They brought rates up, rather, and a lot of people here had adjustable rate mortgages. So as the Federal Reserve benchmark rate was going up, people's mortgage rates were going up. Their monthly payments were changing month to month, going higher and higher and higher. And this led to a bunch of foreclosures. And when all those houses hit the market, there was no one able to buy because there was a recession. And also there was so many houses on the market that the prices came down. This led to a massive dip in inflation, right? Now we'll go over right here. Check this out. This is the inflation chart from the Federal Reserve. So in the 2000s, inflation was going up. Then in 2008, the financial crisis took place and inflation went down. And how far down? It actually went negative to deflation. First time in a long time that they had deflation. And after that, what happened? Inflation stayed pretty normal, pretty flat. Interest rates stayed pretty flat, right near zero. And then in the 2000 teens, right at the end of Obama's second term, they started raising rates. And they got the rates up to 2.5%. COVID hit. They dropped rates to zero. People were unemployed. Businesses were shutting down. The federal government had to do something. So the federal government got all kinds of spending packages in to make sure people were being paid, to make sure people wouldn't lose their homes. And then the Federal Reserve dropped rates to zero just to spur as much growth as possible during that crazy time. But what happened with all that money and cheap money coming into the system? Right? Check this out. Inflation came back nasty. Worst inflation in over 30 years. Over 8% inflation in 2022. It was just crushing people. So what did the Federal Reserve do? They raised rates. They made the cost of borrowing money more expensive. And through a ripple effect through the system, when money is more expensive to borrow, people can afford fewer things. They can afford a smaller house, or they have to wait for rates to come down so they can get a house at that price because the cost of borrowing money is very expensive. Same for a business. If you're looking to purchase a van, let's say, for a painting company, you can't get that van now. You can't get those painting supplies. You can't get the paint, can't get the brushes, can't get any sort of lumber. Now, when no one's buying the van, the paint, the supplies, the lumber, the people selling that stuff, they have to lower those prices if people can't buy it. That is one small tidbit of how the ripple effect happens with interest rates going up. So I won't get into the weeds with that. But you can see here, inflation is definitely starting to come down. Now, we're at what they call the last mile. The Federal Reserve wants to see inflation, at the 2% range. In 2020, we were there. Now we're way above it. And we're still above it here at about 4% for the year of 2023. But check this out here. I go to the economic data calendar. This is free. I highly suggest you guys become well-versed in this. And I'm going to come down to the Federal Reserve's favorite inflation piece of data, one of their favorites. So like I just said, they want to see inflation right around 2.5%. Right here, the PCE. PCE is one of their favorite pieces of data, and it shows year-over-year core inflation. Check this out. 2.5%. So we're not far off the mark, but we are in that last mile. And why the Federal Reserve is keeping rates where they are right now is they don't want it to come back to bite them, like it did here in the 70s and 80s. And let me go back to that real quick. In the 70s, they had real nasty inflation. So look at 1974. Let's go over to 1974. Look at the interest rates then. Almost 13%. So the Fed raised rates to deal with that inflation. But you can see here in this gray shaded area, a recession took place. Let's go back to the inflation chart. And inflation was starting to work its way down, 11, 9%, even made its way down to below 6%. But since there was a recession going on, the Fed decided to cut rates a little prematurely. And what happened? Inflation went way up to over 13.5% in 1980. So what did the Fed have to do? They had to raise rates again. Look at these rates. Almost 20% the benchmark rate was at. Mortgages for homes were over 20%. A lot of my older colleagues told me about trying to purchase a home during that time. Very difficult times. Caused another recession and then another one here in the early 80s. They had something called stagflation taking place where there was a lot of inflation and no growth. So they were really stuck in a hard place. Won't get into the weeds of that either. But back to this economic data calendar here. Lots of good stuff here, but check this out. The cost to employ someone is going down. They were expecting it to be at 1% of an increase, and it's actually 0.9. The Federal Reserve sees that and says, you know what? It doesn't cost as much to employ somebody. So that means things are slowing down. And check this out. The economy was expected to add 150,000 jobs, and it only added 122,000 jobs. Now that's bad for the economy, but the Federal Reserve sees that and says, you know what? Things are slowing down. PCE is at 2.5%. The economy's slowing down a little bit. The cost of things are going down just a tad. Things are continuing to move in the right direction. So they're not going to cut rates this time, but they might next time. And what's one of the things that most people are most concerned about? It's their mortgage rate. You could see here back during when COVID took place. See, I'll go to this chart here. Zoom this out a little bit. When COVID happened in 2020, Federal Reserve, they dropped rates to 0. Made the cost of borrowing money very cheap all the way through 2021. So mortgage rates dipped all the way down below 3. And then you could see as interest rates started to increase in 2022 and 23, so didn't mortgage rates. So a lot of people who have purchased homes here in the last 2 or 3 years, they're stuck with a mortgage rate that they're not too happy with, because a lot of people 4 and 5 years ago were able to get rates at 3 or below 3. So we can see right here, mortgage rates are starting to move in the right direction, starting to come down. They got as high as 8% last fall, but now they're starting to work their way down. So let's keep our fingers crossed for more inflation data that's coming in good, so that the Federal Reserve will be able to cut rates, and therefore, if they can cut rates here, the cost of borrowing money will be a little bit cheaper, which means borrowing money for a mortgage should get a little bit cheaper. All right, and with that being said, thank you so much for tuning in. I hope you guys enjoyed this video. I'm going to start doing a ton of videos like this. I'll be also doing some deep dives in what some of these things mean. I didn't want to get into the weeds of things in this video. So if you have any questions, drop a comment below. I'd be glad to answer that for you. And until next time, thank you so much.